Hi, everyone. I'm Rick Bensignor. Today is Tuesday, August 23rd. Welcome to this week's In the Know Trader Show. We've got a great show for you today, and what we're going to talk about in our trader education portion is why you don't want to rely on your ability to pull the trigger in real time. We'll talk more about that. And then in our stock focus section, we're going to look at the biggest names in the Dow. So there are 30 names, of course, in the Dow Industrials. We'll take a look at the top 10 cap-weighted names. So we'll go through each one of those. Here they are listed in order of cap. Of course, we all know Apple is the biggest name out there in the marketplace, not just the Dow, but everywhere. Followed by Microsoft. Both are multi-trillion-dollar companies. And then, of course, you've got United Health, Visa, J&J, and so on, down to Home Depot and Chevron, rounding out the top 10. So we'll take a look at each one of those charts and see what we see there. And we'll also essentially compare how those line up in relation to what we see in the Dow itself, and whether or not if these 10 names really reflect what the Dow looks like. Remember, the Dow is not a cap-weighted index like the S&P is. It's a price-weighted index, which means the higher the price of the stock, the more it has a weighting in how the Dow Jones calculates its actual index performance. So that's what we'll take a look at while we share our time together. I want to remind you to sign up for my weekly ETF Tactical Trader Report. It comes out Thursday nights most weeks. You go to inthenowtrader.com. What's the weekly ETF Tactical Trader Report look like? Well, it's a combination of getting my in-depth views across the macro picture of the market. So we look at the deep dive into the S&P. We look at the bond market, credit markets, the dollar, often gold, oil, the energy sector, what you need to know about in order to properly position yourselves across the different asset classes. Then I give you a brand new ETF trading idea each week, and that holding period is typically multiple weeks to multiple months. It is not intended to be long-term holds, although occasionally we do have some types of trades that we put on that we hold for a fair amount of time because they've moved our way and they continue to, and the picture has improved, let's say. So for instance, we've been long natural gas since I think it was December of last year. But by and large, most of the trades are in the short-term time frame of several weeks to several months. It's not intended to be quick in and out trading over a couple of days. If you're looking to do that, go elsewhere. Good luck in consistently making money in that type perspective. We do very well in this kind of shorter time frame that's not very short term. Then we also have a monthly 7-Eleven report, which is designed to outperform the S&P. So essentially, it replicates a portfolio maxing out of the 11 sector spider ETFs that exist. Let's say XLE for energy, XLK for technology, XLY consumer discretionary, and so on. You know, there are 11 different sectors to the market at the macro level. So we choose no more than 7 of the 11 to be in at any given time for the month, in order to hopefully avoid the underperforming sectors and essentially beat the market over time. And right in front of you, you have our statistics on this. This year, we are outperforming through July 31st by 2.6%. We outperformed the S&P 6 of 7 months. Since we started this report August 1st of 2020, so that's now 24 months ago, we have outperformed the S&P by 7.16%. That is a huge gain in money management terms. You will be hard-pressed to find a diversified portfolio that takes equal or less risk than the S&P does that actually outperforms it. So these type statistics put us in the top 10% of all people essentially managing money and or instructing how to align your portfolio in order to beat the S&P. So that comes out once a month on the last day of the month so that you have the proper allocations for the next month. And a lot of times we hold many of these sectors for many, many months because they're thematic sector outperformers, and we'll hold on to them. And we may tweak a little the amount of overweight you have in them, but basically these are generally meant to hold for several months at a clip in order to capture the major moves in the relative performance of the sectors to each other, with the goal of outperforming the S&P. Also, I want to just in doing some information to you, I've started my own YouTube channel. It's the In the Know Trader YouTube channel. I am no longer doing webinars for stock charts. So these are all posted through my own channel that I produce myself. You can go to YouTube, search for In the Know Trader, find the channel, and then follow it. Again, I am not doing these anymore for stock charts. So you need to follow me through my own channel now to get these weekly educational webinars. And of course, my Twitter handle is @InTheKnowTrader. So follow me there too to get my latest thoughts on the markets. All right, let's take a look and kind of go back to this idea of not relying on your ability to pull the trigger in real time. So what do I mean? I did a webinar on this, I think, back in the spring or very early summer, just in general, a similar type of theme where you want to have resting orders put in place at the levels that you believe that you want to put your orders and trade at, but you want to have those orders in well before you get to those prices that you want to trade at. Because in real time, if you've got, let's say, a market's moving higher and you want to lean into the rally, as we've done recently on this rally that started in the middle of June when the market made its low for 2022, we had very defined levels at where we wanted to be sellers at. And we'll take a look at this in Dow Jones terms in a second. But the important thing is that we gave you the levels to sell at probably 6 weeks before we ever got there. And you basically had very little time to be able to get those orders off if you didn't have a resting order in. So either A, you were not in front of your screen at the time, or B, you thought the market would go higher, so you tried to kind of inch out some extra gain. Essentially, greed took over, and if you didn't act very quickly, in S&P terms, the market fell as much as about 200 points in 2 days. That's well over 4% in 2 days, almost 5%. So it's really important that if there are levels in the market that you want to, you want to play against, if the market gets up there, you want to have your orders in place before it actually does, so you don't second guess yourself, so you don't go for that extra money, so you don't go, maybe I'm wrong and this line is going to break and it's going to zoom higher, maybe I shouldn't sell. It generally doesn't work well to try to time it in real time unless you're a short-term trader, or a day trader where you're in front of your screen all the time and you're watching every little up and down move of the market. If you have bigger thematic types of portfolio adjustments you want to make, as we had suggested, then you want to have your orders there so that as the market comes to your levels, you get filled. You get an email or a notification, hey, you just traded, but you're not sitting there staring at your screen with your hand on your mouse. Should I click or shouldn't I click? Should I wait now? Should I not? That's not what you want to be doing. So let's take a look at a chart now. Here is the QQQs, all right? Probably the second most traded of all stocks or ETFs every single day, simply behind the spiders, right? The SPY, which is the S&P 500 ETF. This is the NASDAQ 100 ETF. So a couple of weeks ago, this is a weekly chart. So this is now real-time midday as I record Tuesday, the 23rd. So right now, spiders are at just beneath 314. So we saw a break 2 weeks ago of the downtrend line. We closed on the high of the week. The next week, which is last week, we opened slightly lower, but then headed higher. So you could have easily, let's say you had a reason that you wanted to sell against here. If you didn't act quickly, you ended up selling lower than you wanted to. Now, the fact that the trend line broke certainly could have talked you out of putting orders up there. However, with the models we use, and this one happens to be called TD Propulsion, the level that we wanted to sell at, which was 330.23, was on the table the same week that we made the low. So while everybody's wondering, I mean, unless you knew it was the low at the time, and look, in real time, this is what you were looking at. The week we made the low, this is the picture. We ended up having a propulsion exhaustion level right at the low, and we immediately were able to determine where we'd want to sell in the future, when and if the market came to that level, if you were in the camp that this is still potentially a bear market and that the move up was a combination of a deeply oversold market that needed to correct itself, as well as a heck of a lot of shorts who had spent, after the low was put in, the next 4 weeks with very similar lows coming in those 4 weeks, all around the 280 level, that if all that selling pressure couldn't knock the market down to new lows, that a bounce was coming. This is exactly what we told in the No Trader clients. And that given the chance to sell at 330, you would want to. And that, again, we told you right after the lows were put in. When the downtrend line broke a couple weeks ago, you might have said to yourself, maybe we'll go above 330. So let's wait and see. And then the next week comes and we open a touch lower and trade higher, and you probably talked yourself out of doing the trade. And yet we closed on the low of the week, or virtually the low. And then we have this again. This is the picture. So this level at 330.23 is a level that we told you right when the market made its lows, that this is a critical level and that you'd probably want to use that rally to lighten exposure. And the whole point of this is that if you had put your resting orders in and believed that that was a place that a rally, if achieved, would likely stall at, which was not obvious at the time, that would even match with the trend line, because at the time, again, when we made these lows, we can see where the trend line was at 340. We don't know how long it's going to take to get to this level. It could come in 2 weeks if we had a massive surge. It could take 2 months if it took a long time, or 5 months. We don't know. We knew the level. And the point is, you want to have your resting when you know you're going to trade and you know you want to do something. Put your orders in and have them resting there such that if that price trades, you don't have to second guess yourself. I'm going to show you something else I did in my own account. This is not something I put out to clients. It was a daily chart of, I remember I did this off of in Netflix, and from some calculation that I had done, here, wait, let me show you something here. So you'll recall back in April, Netflix fell apart. And, a single day when the stock was down, what was it, 30% or something in a day. And it changed the whole picture of what Netflix had looked like before then. I was able to do a calculation that said to me that if Netflix got to 164 point something, I would take the chance to be a buyer. And we were trading, we had sold down to 220-ish or so, 225, I don't know, where was it, 226, the day of the earnings. And there I am putting in an order at 164, way, way, way beneath where price is trading. The low, several weeks later, look at the low, 162.71. So I got filled on my 164 bid. If in real time this had happened, there's no way I would have picked that. I'd still be saying this is a disaster. But I had, again, a calculation that allowed me to come up with a level that I was going to buy Netflix at, regardless of the news at the time, whatever. I was taking a stand at 164. We go from 164 to, if I remember, a little over 200. We pulled back, and this was tough to deal with because we got all the way down to 164 again. And I had only sold half at 195. And I held it through this. And then, of course, now you have this, and it was actually out of the rest, up around 229. That simply occurred because I had a resting order in. I would have never bought that at the time. It was something I just put in as a good till cancel order and let it be. And I took my chances that that was the place to be a buyer. So I'm out of Netflix. I have no position now. The point being, I had a level that I knew if it was going to get to, I was going to buy, and I did not want to have a reason to talk myself out of it. So I put a resting bid in, a good till cancel with the brokerage firm. Looks like 20 days or so before it ever got there, on the odd chance that it would fall to that price. And in this case, it did, and it worked out very well. You can always put in a resting stop out beneath also, so that if you get filled and it breaks a level that you don't want to see happen, you put in a resting order also. The point is, don't count on yourself to have the ability in real time to be able to do some of the difficult things that one needs to do when markets are moving very quickly and you need to make decisions. Okay, that's that. Let's move on to our charts and take a look first just at the Dow itself. We're going to look at the Dow through the diamonds. The ETF that tracks similar to the spiders or the QQQs. It's just the easiest way for me to look at it and put models up. Here's the picture of the Dow. And in general terms, let's take a look what the cloud model says, because that's certainly one of the things we're going to look at consistently. Let's look at what sequential has. All right, so the big picture is upside exhaustion signals in October of last year that tests the risk level to that upside exhaustion signal, never closes above it. We get the breakdown. The first breakdown this year, we'll say the lows of the year. Notice the lagging line right against the bottom of the cloud. And even this rally that stalled with the at the propulsion level also happened to be the close last week, or the week before that, actually. The high close was the lagging line against the top of its cloud. and we've started heading lower. Of course, the lagging line is just current price pushed back 26 bars, and how it relates to the cloud is all part of the cloud model. So not only did we stall against the bottom of the cloud, we also literally stalled against the propulsion momentum level that would have had to be properly exceeded in order to eliminate or let's say neutralize the entire down move. It didn't happen. That still makes the bear market intact. And as I said in some other webinars I've done, I think we're heading down to here. Let's put a little circle here. So off of those highs, this is where I think we're heading. Now, to put that trade on now is not worth it, because in real time, we're at 328.64. We're only looking for a move that gets you to 325 to 322-ish. So you putting on a short now to play for this, you'd have to risk a heck of a lot more to prove yourself wrong. So it goes back to why you needed to sell at the levels we told you to, and have that ready and waiting. So if they got there, you got them off, because now you have a much tougher decision and not even close to an equal risk reward type trade as you did when we were sellers up here. So that's the look at the Dow chart. Let's also, I do this each week too, whatever sector we're focusing on, and this time it happens to be the Dow, so it's not a sector, it's a big index itself. We always compare it to the S&P. To get relative performance. So you can see that the diamonds from last November outperformed the S&P, topped right on a sequential 13. That is the trend exhaustion signal from this particular Tom DeMark model. And since then, the diamonds have underperformed, which means the S&P is outperforming. So this model gave us a sense too of where the Dow would stop outperforming the S&P. Right now, we've come back and bounced at the same, virtually the same level of where this old high was, which was accompanied by a setup 9 count. So we do have some intermediate support. We could say, let's just put a line kind of at this level, which captured that high and this recent low. MACD is certainly crossed, starting to flat out a bit. RSI has come back down into neutral territory. So right now, a more difficult task to figure out which of the indexes you prefer to be in at any given time. And I can tell you too, in general, you want to look at QQQ versus spiders, diamonds versus spiders, IWM, which is the Russell 2000 versus spiders, and any of them against each other. Because if you're going to put a macro bet on and just say, I'm bullish the market, there's generally one or two of these that are going to stand out as being the better ones to be in. So certainly for the last several months, the diamonds and spiders have been better, have better looking charts than the Qs and the IWM, right? So small caps and technology have had much worse looking charts. So if you were long either of those, you did worse, and you continue to do worse than if you were in diamonds or spiders, meaning the Dow or the S&P. So if in your accounts that you trade and or invest in, you're holding any of these major passive indexes, you want to kind of know which ones to hold. And this is not to trade in and out on a consistent basis. This is, again, out of those 4 indexes, usually 1 or 2 of them are stars relative to the other 2. So if you're going to be long something, you know, you've been better off in the spiders or the diamonds. Even though the market's down this year, you lost less than if you were in Russell or the NASDAQ 100. So that's something you should be doing with some consistency every month or so. You know, pull up weekly charts, just get a sense of which ones are doing better. It's very helpful. All right, let's take a look at the individual names now. We'll go through 10 names fairly quickly on what we see. Okay, here's Apple, the king of them all. Topped on a setup 9 count, bottomed on a setup 9 count. At the same time, lagging line is against the top of the cloud. So support from the cloud model. Timing model says possible downside exhaustion. Now, this has passed through the level, its propulsion level, which came in much, much lower in relative terms than any of the other indexes. But we did stall right against the TDST line. That's the highest high in the 9 count. Usually bar 1 or bar 2's high is the bar that makes that level. And that says there is resistance there. And now we've pulled back. So minimum downside on Apple is that I'd say we probably get to is, I'd say 162 and change. I think on this pullback, we're going to see 162 and change to 160 and a half-ish. A bigger pullback pulls us all the way down into the mid 150s. On the upside, all depends on what we do this week and next week. Don't forget, Fed Chairman Jay Powell speaking Friday morning, 10 a.m. New York time, at the Jackson Hole conference that all the central or most of many central bankers of the world get together in Jackson Hole, Wyoming at the end of each summer to hobnob and kind of talk about what they're seeing in their own countries. And Jay Powell will be talking 10 a.m. And that is going to be a very important press conference for how he talks about interest rates, what the Fed still needs to do, and how hawkish or not hawkish he comes across is going to determine how the market moves going forward from there. A lot of the sell-off we've seen this week is in anticipation that he will be more hawkish than he was at his last press conference, which helped zoom up the market from the July meeting. And there's already there's already some consensus that he will be more hawkish, and that is why the market has come off. So he would need to be extremely hawkish at this point, given how much the market fell in the last several days from the recent high. He would have to be extremely hawkish in order for the market to really get beaten down badly on Friday. And if he's in any way dovish, the market's going to turn around and go higher. So that's what we've got there, and that's kind of the picture of Apple. If you get this can be tough because we could break above resistance at the same time we get a 9 count. We've seen the last couple of, in fact, the last 3 or 4. Look, 9 count turn and trend, 9 count stall and turn and trend, 9 count stall. Not a big trend changer, but at least a stall for a couple months. 9 count stall for 3 months. So we know 9 counts can certainly turn things around. If Apple were to go significantly higher, then I could put about a 196 target or so on it. But it's going to be a tough call just because of the timing and how close we are to resistance. Microsoft, 9 count also right near the lows, held multiple weeks against this TDST line, barring one doji move here. That's a Morningstar candle pattern. For those of you who know that, we've moved up. There is going to be resistance now at 297-ish. We got close last week, so I'm not sure if that's going to be strong resistance. More resistance of significance, just about 311 right now. Let's go to UNH. UNH, 9 top, 9 just before the top, 9 right by the bottom against TDST line support, held above the cloud. This is a much stronger chart than most of the other charts. Just a week ago, tested all-time highs, has pulled back a bit, but if we stay above 527 or so, well, let's call it 523 this week on Friday's close, then we're holding support, and this could very well end up going up to 620-ish or so. So important whether or not this ends up turning into a double top or it breaks out from there. What else do we have? Visa, ticker V, complete sideways market for 8-9 months already. Nothing to do here of significance. So there's just no vig in all in trading it. J&J. Also pretty much sideways, did poke to a new high in April, pulled back, holding cloud support in here. If you're long, you're going to want to see this hold 164 on Friday closes. Otherwise, that opens the door to a move to 156 3/4. Look at MACD. It's not particularly good. It really needs to hold 164-ish on on the pullbacks, especially if we close beneath it this Friday and next week's a down week. We will go in all likelihood to test that 150, just beneath 157 or so. Walmart had some earnings troubles back in May. That was the complete slamming of the stock. Same thing, 9 top, now 9 bottom. We're on an 8 count up, stalling against the bottom of the cloud and the weekly conversion line from the cloud charts. We're kind of in no man's land here. Notice that there were several lows in the past, kind of, let me kind of right in. Oh boy, this just doesn't want to play nice today. There we go. So somewhere right around the 135 level. We're virtually there now at 134 and change. Kind of tough because you've got some trap buyers above and trap sellers beneath. So this could kind of stay sideways for a bit more. Procter and Gamble Pg. Let's see. Up, down. So if this week closes down and next week closes above 147.25, we probably head higher with possibly a target up at 165 to test the all-time highs. Don't want to see it break beneath this dotted line, which it had one close beneath it and came right back. So that's still active. Let's call that 139 important support. JP Morgan. Structurally not healthy beneath the cloud. Let's see, bottomed against the propulsion exhaustion signals that are back from last fall, have moved up. Look for this. The key level going forward is just about 130 or so, whether or not it can get above there. It happens to coincide with some of these highs back in late spring, but it's kind of unrelated to that. So that's going to be, this needs to get above 130. And basically, you do want to see this week hold on to this line at 115 and so, or so. Home Depot. Tough name here. Cloud's not helping much. Stalling against what had been prior support, but it didn't even act much like support. Tough name. I see the cloud going forward has flipped too. No real vig in playing this name. And the last one is Chevron. Chevron pretty much topped on a sequential signal here. Has been trading off since, but it's still above its clouds, structurally healthy. Going forward over the next, through the balance of the year, you want to see this name stay above 133. It's now 161, so it's got plenty of room to hold. But structurally, as long as this stays above 133, it's still a long-term hold. And if oil does a complete turnaround and heads higher, and this makes new highs, look for 193 to 187 to be targets. So that's it for this week. Hopefully you understand the whole point of having resting orders in place well before a market gets there, so you don't have to have any head games going on and talking to yourself, and you just get your orders done where you always said you wanted to. I'm Rick Bensignor. This has been In the Know Trader. See you again next week.